Hello everyone. The wind of change is now blowing on bond markets. Let's see how. So we had a brief period of hesitation where the fair price for new bonds was difficult to find. It slowed the primary markets, but that's no longer the case. According to a Bank of America Merrill Lynch survey, the prevailing scenario of higher rates for longer was short-lived, and all it took was a Federal Reserve meeting and falling inflation figures in October for markets to change sides. Surveyed investors no longer see any rate rises and are expecting even lower rate in 2024. And as a result, they are shedding cash and overweighting bonds to the most they have since 2009. This shift is not linked to a change in economic outlook, but to expectations of lower inflation and lower interest rates. Investors are therefore flocking to bonds on a massive scale, favoring long maturities. The wave is also spreading to Europe, and the tightening of concession premiums, the additional price to pay to issue a new bond, speaks volume about the market's appetite. But let's take an example. Veolia Environment issued a new hybrid bond on November 13. The bond attracted almost 3 billion euros of interest for a 600 million euro issue. This has enabled Veolia to tighten its initial guidance, 50 basis points, from 6.5% to 6%. Said differently, this means a yearly interest savings of 3 million euros for the company. The example of the European Union is also telling, despite the intermediate maturity. A new 5-year bond that was more than 13 times oversubscribed, and order books even exceeded 100 billion euros during the day. Switzerland is no exception to this new paradigm. While the market is used to full allocation and stable indications, things are changing. Tightening initial guidance and cutting allocations are the new orders for the day. In the US, investors are flocking to 30-year issues. According to IFR calculations, there are fewer new 30-year issues this year than last year. And understandably, issuers do not want to commit themselves for such a long periods with yield exceeding 6%. But those who have dared have been rewarded with a warm welcome. Duke Energy was one of those who took the plunge, finally issuing a 30-year tranche that was larger than the 10-year maturity, an event that is rare enough to warrant mention. So even though the risk premiums are not very high and even have been revised downward from 170 to 142 basis points for the 30-year Duke, the expectations of falling interest rates are taking over. Between November 6 and 15, the risk premiums continued to narrow to 134 basis points, and with yields falling, the price of the bond soared to 103%. In other words, the higher for longer scenario has been blown by the wind and will not have won unanimous support for long. Thank you.